Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
Hey, Duncan, welcome back to News You Can Use.
Great to be here. Thanks.
Yeah, still bizarre, extraordinary, fascinating, crazy, roller coaster. I don't know how you would quite describe this year, but let's go to work and see if we can inform our audience a little bit to try to take the extraordinary, bizarre, fascinating circumstances and distill it down into what they need to know in terms of moving forward with housing. So we started 2020 with historic lows in employment, 3.5%, all-time low. Interest rates at 3.5%, kind of generational lows. And your award-winning forecasting team was predicting at the time that housing sales would be up around 2%, a little bit less than 2% for the year. And then COVID-19 showed up. And we did something that this nation has never done before. We kind of closed a good amount of the economy down, at least temporarily. We shut down everything that wasn't essential, if you will. So all this happened, and we're still dealing with COVID-19. Maybe it's worse today than any of us could have imagined. And housing sales now, you're forecasting, are going to be up for the year of 2020. Help us understand exactly what's happened, please.
Well, this is one of the things to think about if somebody asks you to become an economic forecaster. You want to think about this. There's 3 rules to that. If you give a number, don't give a date. Second, if you give a date, don't give a number. And then third, if you get it right, don't look surprised. So the word you didn't use is unprecedented. And we ran a note through for approval from our regulator back in April using that word. They said, we don't like that word. And I said, well, then what's the precedent? Because there isn't one for, to your point, shutting down the economy, which we did for the months of April, late March, April, and May. We basically closed the US economy. So we saw unemployment go from 3.5% to 14%. And there's a lot of more people that are not included in the unemployment numbers for various technical reasons. So that there was no precedent. Even the Great Depression was not that rapid in terms of the economic decline. So the way to think about it is this is not a forecast is built off the relationship of past economic variables to future expected values for those economic variables. This is a health variable. It's not in economic models. And it depends on the incidence, duration, and severity of that disease and the response of people, businesses, and governments to that. And all those things work together to create an unprecedented slowdown. Now, there was also unprecedentedly fast reaction at the federal government level. I have to say, the CARES Act came together very rapidly and was quite effective. It's one of the real examples of where, when working together, good things can be done through the federal government. And it definitely sustained activity and is still sustaining some activity. So the rebound has been stronger than what most forecasters anticipated. Our view was it would be a partial V recovery. I think you and I talked about that in the past, and that's turned out to be pretty true.
Yeah, so I went home kind of the day that the shutdown went into effect. For all intents and purposes, we sent all of our folks home. We had not worked virtually. Some of our team had, but most of the operating group at least was physically here in Alpharetta, Georgia. I remember going home and it felt like a little bit like 9/11, which is, this is an event that just hasn't happened in our country. And now how are people going to react to it tomorrow? So, I was out to dinner this weekend. I did wear my mask, but it seems like with the numbers worse today than they were back in March, it seems like the fear of COVID-19 has come down. And not that that's true, but it feels a little bit like that's what's going on, because the restaurant that I was in was pretty packed and people didn't seem uncomfortable like we did back in March and April. Does that help? Is that true? Is that something that you all are seeing in your surveys right now?
It is. The resurgence of the virus has slowed people's actions. So the pace of growth has clearly slowed, but it doesn't seem to us like it's going to slow enough to reverse into a second leg of downturn. I think part of it is that the people have come to understand the folks who should fear the morbidity of the disease. And it tends to be older people with pre-existing conditions that would relate to that. So to that extent, others are not as fearful as they were. So there is underway some additional slowdown, but we don't think it'll go back to where it was.
You know, it's interesting because the fear issue, of course, I'm a big college football fan. I'm happy that they have the season going on, particularly because I'm an Alabama fan, but put that aside. When they cancel a game now, they don't talk about the concern of any of the young folks from a COVID-19. They talk about, well, they can't play this week. They'll have to reschedule it for next week, which to the point of who winds up getting it and what's actually the outcome. But that all comes back to this concept of fear. So you have a survey that you all do there monthly at Fannie Mae, the HPSI, the Home Purchase Survey Index. Tell us a little bit about that. What's the input and what has happened during the course of 2020? What have the feedback's been, if you will?
Sure, it's a monthly survey that we started in June of 2010. It's a survey of 1,000 households across the country weighted to represent the U.S. population, meeting all the federal statistical properties. We make that all publicly available, so if people want to review the science behind it. It's a tiered set of questions intended to drive to what are people thinking about their housing situation and whether or not it's a good time to buy a house or not, or sell a house or not. So it's really a survey of consumer sentiment related to housing. It's been a really, really good tool for predicting behaviors. Based on that survey, we were, probably 2 years ahead of anybody else, suggesting that supply was going to be the issue. Because when we looked at the behaviors of suppliers and demanders within that survey, it gave us the indication that now, if you look at the supply function of housing, that's where the problem is going to be. It also told us from the very first survey that we did in June of 2010, the stories about millennials not wanting to own a home, they're wrong. Because in that first month, 91% said we eventually want to own a home. Just we have to have a job and we have to have an income, which seemed reasonable given what we saw in 2007 to 9. If you're going to lend money long to somebody, give them 30 years, if they have a job, that's a good thing. So it's been very helpful. So what has it recently been telling us? It's telling us now that house prices are starting to bite and that people do expect rates to move up. And particularly, and we can divide it by age group. And we can divide it by owners versus renters. Two things of significance in the most recent month. One is that the 25 to 34-year-old group, which is where the upcoming first-time homebuyers are now concerned about house price appreciation, especially when compared to their concerns about their employment. So that's one thing. The second thing is there's a clear separation in attitude between owners and renters. And that's the widest gap there's been. And you see that in the headlines about eviction moratoria. And for housing, that's a problem because the demand comes from renters moving to own. There is a jump in that today. That's part of the push is people being concerned, people who are close to owning a home, but yet renting in an urban core, they are now, because of fear from dense population and the COVID, we have clear evidence that at least for now, many of them are making a move out of the urban core, further out to less dense. But you can see that data in New York, in San Francisco, in Boston, in Chicago. And it appears that the beneficiaries are smaller population areas, which have less expensive housing and less density.
Yeah, so the idea, the advent of virtual becoming certainly in the short term, but as employment goes in the long run, more likely, because even our organization, we're not sure a lot of people are going to want to come back because they've learned how to work now out of their homes, and the productivity's been better than expected from our vantage point. Of course, we focus on our culture here, so we'd like them to come back. I give them now virtual hugs, but I'd really like to hug them again someday. So there's that, and then the lower cost of housing potentially being in some of the cities that you mentioned is drawing people potentially away from the bigger cities in the country, and moving them more towards smaller marketplaces and rural. You expect trend-wise for that to continue?
I do for a while, until there is broad-based comfort that getting back together with people in close proximity in large groups. You know, you mentioned the football games. You see the cutout figures and a few people sprinkled here and there. You know, that's this. The sections of the economy that have been hurt are those which are discretionary spending by middle and upper income households, and they're in things which require the aggregation of people. So it's sporting events, theaters, concerts, airplanes, hotels, conferences. Those are the things where the damage has been, and it's going to take some time to repair. And those are largely populated by hourly wage workers, which are more typically renters. So in terms of future demand, the longer it takes to rebuild that, the more of a delay there will be in that first-time homebuyer population after this current wave gets through.
Any change in the survey based on the election, or is the most recent survey not indicative of post-election? If we are post-election, I think we're post-election.
Not quite. I think you're in Georgia, right? There's a little bit.
That's right. That's right.
So a little bit. There's some response related to the election, and it tends to be in the small business sector. And by the way, we have a parallel survey to the HPSI, which is a survey on a quarterly basis of the mortgage industry, the mortgage lender sentiment survey. And so you can see it in that survey as well. It's not as pronounced as the initial election of President Trump. There was a big shift in optimism, particularly among folks focused on small business because of the regulatory environment. That partially got reversed in this election in the data.
So we'll keep a close eye on that going forward, because to the extent that the new president takes office and we start hearing some of the conversation about priorities, then we'll keep an eye on that. Maybe we'll talk about that during the course of the of 2021. All right, let's shift our conversation now to 2021. I'd like this year to end. I'd like the election to be over. I'd like us all to sing Kumbaya together instead of being a nation divided. We're for everybody, not for everything, but we're for everybody. Remember that if you're out there. Wear your mask too. Just love your neighbor, wear your mask. All right, let's shift the conversation to 2021. Your team's best thoughts regarding the U.S. economy in 21.
Well, we're right in the middle of a forecast cycle right now, updating. And of course, this will be the first cycle post-election. So we're having to think about what does that mean? Right now, there's a discussion underway that's close to coming to agreement on stimulus to be passed in the lame duck session. That's actually fairly important for two reasons. One is it would make it sooner that there would be relief, particularly targeted toward those renters, small business, some of the state and local governments. But it would take off of the new administration's agenda the stimulus being the first thing. So if they don't have to do that to start, then they're going to look at other issues. Well, that stimulus will pair with what's already in the market through the Fed. And household, if you look at savings rates and incomes coming from transfers, they're much higher than they were in the 2007 to 2009 time period. So there's actually a lot of tinder out there for consumers to light and push the economy up. If a virus vaccine, it can be broadly distributed through the economy and people get comfortable by mid-year, the second half of the year could really take off in terms of growth. That's a scenario. Now, it depends on a couple of things, right? It depends on when this stimulus gets passed, if and when. It depends on the vaccine being effective and being broadly distributed. So it's a scenario, but it's one that we're seriously considering. If neither of those two things happen, we still think we'll get 3% growth or so across the course of 2021. And from a housing perspective, if that first scenario occurs, could be that rates rise in the second half with all that growth. And if the Fed responds, that would be tough for housing.
Yeah. So, so basically, when you say tender, pent up spending has been concerts, games. If we get past vaccine and it proves to be effective, you'll see a lot of momentum then take place. And there's a lot of stimulus out there, dollars in people's pockets. And then we'll have new jobs getting created at a pretty high rate. So that and then what next? What next? Because we talked a bit about this, but what next in terms of regulations? Does that kind of act as the barrier for growth if we wind up getting a lot of new regulations into the next administration?
Well, if you go back to the campaign and what were some of the policy proposals by the Biden administration, clearly the environment is on their mind, climate change. So that's an issue that typically invokes greater regulation, changes in rules according to energy sources. The second thing was a discussion of raising taxes both at the corporate level and at the upper income personal level. So both of those things would be on the agenda. A lot of the people that have been proposed to be on the economics team were actually people that were on the economics team in the Obama administration, not all, but most of them. So you can kind of look back on that time frame and get an idea of what kind of economic policies you should be prepared to expect.
So specifically, 2021, what's the team, your team at Fannie Mae, predicting in terms of housing sales?
We think it'll be up a little bit, about 1% total higher than this year. You might ask, if rates are going to be low, why wouldn't you think it would be more than that? Well, for one thing, in the new home, in the new home market, the share of new homes being sold today, which are not even built yet, are the highest ever in that recorded data series. So the builders at some point have to catch up to be able to get the inventory catch up. So they're going to slow down in terms of the number of sales last year as they build to meet their current obligations. It's not clear on the existing home side that even with an effective vaccine, the boomers who have said they're going to age in place won't still just be aging in place. And so it's not clear to us that the supply on the existing home side moves that strongly. And you would have to see more freeing up there to see the existing home sales numbers pick up.
So if we had unlimited inventory, or forget pricing just for a second, but if we had unlimited inventory, then the number forecast for 2021 winds up reflecting something far different than maybe just a 1% increase.
That's absolutely right. Yeah, completely.
So,
plus, I mentioned earlier in the HPSI, the pace of price appreciation is starting to bite.
So COVID management certainly has been, well, let's say it's been one of those interesting debates that the country's had, right? The state and local governments, how they've gone about, they're not really, it's not just a debate, it's an argument that's happening, right? There's people who don't want to be managed, people that do, and then there's those that are in between trying to figure out on the margin how to both be respectful to the disease or virus and at the same time keep people employed, which is kind of an important thing as well. So there's that. Does your forecast in 21, I know you don't release it by market, but does it reflect those differences? Meaning in housing, we're going to be up 1% roughly, right, if the forecast is right. Is it going to be much better in certain areas and really much worse in certain areas because of the management of COVID and or flight of people from maybe the same into different places? What's your thinking about that, Doug?
Yeah, we're tracking that. So what we've done is we've taken a look at the degree of tightening by governments in the different states, and then looked at the performance of those state economies relative to that. And there's no question that those states which had tighter lockdowns clearly had lower economic performance. And also that's where you're seeing a shift in population from and to places where there's a better business environment and also a more relaxed environment in terms of the virus. So there's no question there's an economic relationship to how the virus is accommodated.
So no politics. That sounds like it would be a good thing for the Southeast. It's warm here. We're pretty much open still as it goes in terms of business. Wear your mask, love your neighbor. But does that play out in your forecast? Do you see the Southeast region doing kind of on the margin better than the nation in terms of housing in 21?
I do. Yeah, I think the Southeast will be, it's been a strong sector. If you look at the housing sector and general economic data, it's in general, a better business environment. So you take, for example, Florida has no state income tax, Tennessee has no state income tax, low levels of regulation and taxation, Georgia, South Carolina, North Carolina. All of that over the years has shown population migration inbound and working age population. So all that's good news.
So are you tracking ingress, egress population? Do you all do that as a part of your overall forecasting?
As much as we can. We try to draw on a bunch of different sources. There's things like the U.S. Postal Service addresses, United Van Lines data on, you can actually, even if you can't get those numbers, you can look at the cost of renting the same vehicle going from, say, Texas to California versus California to Texas. They're two different prices. And the difference in price tells you which way the demand is going. So we look at those.
Unbelievable. So one of the things that, as I look at your forecast, that is, I have a question about is how the year shakes out. Normally, the first quarter is the weakest of the four quarters during the course of the year, and we pick up in the second quarter in the spring and early summer, and then the summer tends to be when kids once upon a time went to these places called schools. Parents would like to have them move during that time of year to get them in before the football season starts, right? And then and so this year, 2021, you actually have the first quarter, your forecasting team, doing better than the second, third, and fourth quarter. Tell us about that.
Yeah, there's a couple of things going on. One is, of course, interest rates for 30-year fixed rate mortgages at about 2.7, depending on your credit. And that's a very strong urge to move and seize that opportunity. There is an expectation, and our HPSI survey shows the expectation is that rates will rise, which gives you an incentive to move now as opposed to wait. So some of that refinance will carry over into the first quarter, making it bigger than you normally would think. Second thing is that the COVID hit in the March, April, May timeframe in 2020, which is peak home buying season. And that pushed off the normal cyclical peak into the second half of the year. And we think into the first quarter of 2021, some of the purchase activity that would have taken place in that normal spring buying season in 2020. So I think when you combine those two things, it makes it look like a bigger first quarter than you would have expected.
So all things considered, with the extraordinary, unprecedented, bizarre, fascinating 2020, we wound up with a really good year in housing. How we got there was interesting, but we got there, right, and had a really good year. And as I've told our audience, we all should do even more for our neighbors, because this has been a blessed year for those that are in real estate. And now it looks like 2021, even though it's only up 1%, levels are still pretty good. Business is still pretty good. And it feels like the ingredients of a stronger economy, vaccine, stimulus, the refinance stimulus that they don't often talk about that is helping households. It feels like we have a pretty good year coming out in front of us. And even though it's going to be shaped a little bit different than it normally is, maybe 2022, maybe we get back to some degree of full normalcy. I have a question to ask you, and you don't have to answer it for health issues, but vaccine, are you going to get a vaccine if it becomes available to you?
Yeah, I will. Absolutely.
Yeah, me too. And I say that because I have to trust and have confidence in the system. And I think to the extent that all of us have an opportunity to be able to get back to normal, that certainly represents hopefully a hope for all of us to do just that. Last question, is now a good time to buy or sell a home? Keep in mind, you're talking to your son, your daughter, like that treasured person. You're no longer the Fannie Mae forecaster, although you have all the knowledge of the chief economist with Fannie Mae. But advice-wise, what would you tell those that are watching our show today?
Yeah, I'm a broken record on that. If you have a family budget, and you should have a family budget, and if at today's interest rate and house prices, you can afford within your family budget that house that you're looking at, buy it, because then you're a homeowner. If you're waiting for rates to fall or you think prices will come down, now you become a speculator. Can you afford to be a speculator? One thing, I will add one caveat to that. I was thinking about this morning. What you don't want to do, though, is get caught up in chasing price, getting into a bidding war. That's in an environment where house prices are clearly higher than they have been for some time, and they've been rising for some time. It's easy to get caught in the trap that says, if I don't get in today, I'll never get in. And we saw in the 2006-07 period, that wasn't a good way to go about it. So be really careful to stick to those rules about budgets and don't get caught up.
Which gets right back to being smart about your budget, right? Be thoughtful, don't get emotional. One of the things that we're going to be doing, Doug, next year, we introduced a program called Credit Essentials this year, which we run twice a week for our customers to come to so that they can understand what's in the black box of credit to better understand it. And we're seeing our average customer pick up about 65 points on their credit score simply by getting better informed. Yeah, and we're planning on adding the brother to Credit Essentials, which is Budget Essentials, because like you, and that's why I asked the question, I think simple is often brilliant, and the advice of folks getting a budget, really understanding the full cost of owning a home as opposed to just the mortgage payment is always helpful. Listen, we're so grateful to have you with us again today, and we wish you and your family the very best of Christmas and holiday season. Take a minute to enjoy a bit, because you've been a part of this fascinating and bizarre and extraordinary and unprecedented year. So take a minute just to really enjoy family and friends. And God bless you, my friend.
Thanks, Pat. Same to you and your family.